Okay, so this is where we left off on Chapter 9, Accounts Receivable, dealing with the two methods of estimating bad debt expense, which is really more so three methods, but two included in one. Percent of sales method, and then the two accounts receivable methods, which are aging of accounts receivable and percent of accounts receivable. All right, so if we had to use the percent of sales method, this is the equation here. Sorry. Current period sales multiplied by whatever the bad debt percentage is that you're given will equal estimated bad debt expense. So here's an example here. So the example here is Musicland has $50,000 in accounts receivable and a $200 credit balance in allowance for doubtful on December 31st. Past experience suggests that 5% of receivables are uncollectible. So in order for us to get the percent of receivables, we take the amount of receivables and we multiply it by whatever the percent of uncollectible is, which in this case is 5%, to give us 2,500. Now, because this method has to include whatever was prior or the previous balance in the allowance for doubtful accounts, the previous balance was 200. So we take our 2,500 and we subtract out this 200 to get an adjustment of 2,300 for allowance for doubtful. And of course, the balance end of year for allowance for doubtful would be 2,500. Now the agent receivable method, that's a little bit easier because you're going based upon whatever the amount of days past due has been. So you classify each receivable by how long it's past due. It's going to have a different group, 0 to 30, 31 to 60, 60 to 90, and so forth. Multiplied by whatever its bad debt percentage is at the time. And then you total each group. So here's an example. This company in total had receivables of 50,000. Now, not due yet, meaning it's not even past 30 days due. They had a total of 37,000. We just multiplied it by the bad debt expense percentage, and it gives us 740 for this group. And then those who are late within 1 to 30 days, we total those, which come to 6,500, multiplied by the percentage, which is 5%, to get the amount of uncollectible there. Then 31 to 60 days, then 61 to 90 days, and anything over 90 days. Once we get all these amounts for these groups uncollectible, we add them all together, and it comes out to here, 2,270. Even though you have this amount, you still got to adjust for allowance for doubtful. So we know that that amount, that balance was 2,270. That account had a previous balance of $200. So we need to subtract that in order to get the amount of the adjustment. And then we create our journal entry. We debit bad debt expense, and we credit allowance for doubtful for that $2,270 balance. I'm sorry, $2,070 adjustment at the end of year. So summary of methods. If we use percent of sales, it's only going to affect the income statement because we're talking about sales and bad debt expense. And that's the only thing that is on your inventory, on your income statement. If we're dealing with percent of receivables or aging, all of that deals with the balance sheet because we're dealing with allowance for doubtful, which goes on your balance sheet. Let's try this example. It says December 31st, year end, a company estimates uncollectible accounts using the allowance method. It prepared the following aging of receivables analysis. Ultimately, they had a total of 2,600 in receivables. We got to figure out how much of that is uncollectible. So they give you the percentages of uncollectible or bad debt for each group. And we're supposed to estimate based upon what method? Aging. So 2,000 times 1% equals what? What is it? $2,000 times 1%. $20. 300 times 2%. $6. 80 times 5%. 100 times 7%. $7. And $120. 120% times $120 times 10%. How much? How much does all of these uncollectible equal? $49. So now what we have to do says determine what the current account balance equals. We already did. They had a previous balance of $10, which is a debit. And we just determined that how much was uncollectible? 49. So that brings the account balance up to what? What's the adjustment? 59. The adjustment is 59 because 59 minus, 59 minus 10 would get you that end result of 49. So we have to do a journal entry for the actual adjustment, which is a debit to bad debt expense and a credit to allowance for doubtful for that $59. It says estimate the balance of the allowance for doubtful, assuming the company uses 2% of total accounts receivable to estimate uncollectibles. Instead of the aging method, prepare the adjusted entry to record bad debt expense using the estimate from Part A. Assume that the unadjusted balance in the allowance for doubtful is $4. So if we're determining what the current account balance equals, and we're assuming that they use 2% of accounts receivable, then how do we calculate what the balance will be? Which is how much? We said use the previous balance. What's previous? Previous balance.
2,600.
2,600. So you know the adjusted is there for $4, right? And 2,600 times the 2% is going to equal $52. So this is our journal entry. Debit to bad debt expense, credit to allowance for doubtful for $48, which is basically the $52 minus the $4 that was previously on the credit side of allowance for doubtful. It says estimate the balance of uncollectible. They use 0.5% of annual credit sales, which were 10,000. Prepare the adjusting entry to record bad debt expense using what method? This is a percent of sales at this point. So 10,000 times 0.5% equals what? This is the percent of sales method. 0.5%, not 5%. How much is it? Both of those are wrong. 0.5%. $50. I know y'all have calculators in here, right? You should. Just because it's the last 2 weeks of school doesn't mean you don't bring a calculator. $10,000 times 0.5% equals $50, which means the journal entry that we record is a debit to bad debt expense, credit to allowance for doubtful for those $50. We don't assume under the percent of sales method, you do not assume nor do you include any previous balances that were in allowance for doubtful when it comes to making an adjustment. So notes receivable. You've heard of it was 0.5%. If you convert it to a decimal and do 0.005, you'll get the $50. All right. Notes receivable. So this is where a customer owes the company. They decided to write out a promissory note promising to pay, and the company says, okay, I'll put you on a notes receivable for X amount of days, and I'll tack on an interest rate for you to also pay interest once you get ready to pay the full note back. So this is an example of a promissory note. We have the amount, which is $1,000, which we call the principal amount. We have the date in which the note was authorized, which is July 10th. They give them how many days to pay this back?
90 days.
90 days. And they're not just going to pay back the $1,000. They're going to pay back the $1,000 plus interest. And what's the interest rate? 12%. So this is an example because at this point you have to count days. This note was put into place July 10th. So that left how many days left in July? 21, because it's 31 days in July. So it left 21 days, and then add the full 31 days in August. That's up to 52 days, right? And then we are how many days away from 60 days? From 90 days, I'm sorry. 38. So you can add in the full month of September because that's only 30 days. And that means you would be 8 days away from 90 days. So you can only do 8 days in October, which would make this note due on October 8th. That will be the full 90 days. And the way that we calculate the interest is we take principal, we multiply it by the interest rate, then by the time expressed in fraction of a year. So the one different thing about accounting is typically a normal calendar year is 365 days. But in accounting, we do 360 days because it could be based on a fiscal year, it could be based on, you know, exactly 12 months. It just depends on the company. But to calculate this interest for this example, we take $1,000, we multiply by the 12% interest rate, and then we multiply it by how many days over 360. How many days was the note for? 90 days. So that's all you can express it for, unless it's the end of the year and you still have some time to go before you reach 90 days. You have to calculate interest for every year. You can't just wait, and I'll show you an example for that. But 1,000 times 12% times 90 days over 360 means that they have accumulated $30 worth of interest. So when they pay it back, they're going to pay back the $1,000 plus the 30. So this is showing when the note was put in place. We debit notes receivable for 1,000 and we credit sales like normal. And then when it's time to pay the note back at maturity is what we call it. Then it's a separate journal entry. So this says recording an honored note. Honored means the customer is paying like they agreed to. So we're going to show the cash we received. We need to calculate the interest, which is 600 times 15% times 60 over 360 days. And that gives them interest revenue of $15. So they're going to pay a total back of $615. So we recognize our cash at $615, notes receivable at the principal amount of $600, and the interest revenue earned at $15. Now what happens if a person decides not to pay? If they don't pay, it is dishonored. And the thing is, the moment that they don't pay, we take it from being a notes receivable and we make it an accounts receivable. So this particular customer didn't pay, so we calculated interest, it's the same $15, but we're going to take it out of or decrease notes receivable, and we're going to create what for them? Because we didn't receive any cash because they didn't pay it. Accounts receivable. So now we debit accounts receivable for that full $615, credit interest revenue earned $15, and then notes receivable for principal $600. Now, this example is what I was talking about when the dates don't necessarily, or the days don't necessarily accrue before the end of the period. So on December 16th, this company decided to put a note into place for a customer for $3,000, 60-day note, 12%. Well, we know from December 16th to December 31st that it's clearly not 60 days, right? But we still have to calculate the interest that was accrued from December 16th to December 31st for that particular year. So we take 3,000, we multiply it by the interest percent, which interest rate, which is 12%, times 15 days, because it's 15 days exactly from the 16th to the 31st over 360. So for this particular year, when they started the note, they've already accrued $15 worth of interest. So we do a debit to interest receivable for $15 and we credit interest revenue earned for $15. Now when it's time to collect on this, which is in the next year, obviously, there were 15 days left in December, right? And then we know it's 31 days in January. So that would make a total of 46 days after January, which means we are 14 days away from 60 days. So this note will be due February 14th. And what they're going to pay is the interest that they accrued from the previous year, as well as the interest that they accrued for the remaining days. It was a 60-day note, which means they had 45 days left to accrue interest. So we're going to do 3,000 times 12% times, you can either do 45 over 360 or you could do the full 60 over 360 to get the $60, and then of course 15 goes to interest receivable, 45 goes to interest revenue earned for that particular year, and the notes receivable for the full principal amount. So in the event that you have to dispose of receivables, there's two different ways companies do it. They either sell their receivables to companies who are in that business, or they pledge receivables elsewhere. Now, selling receivables, that's no different from a company saying, hey, I'll collect these receivables for you. You pay me either this amount up front, or you pay as I collect them, you give me a percentage of each one that I collect for you. So that's typically when they sell their receivables. It's called factoring. And accounts receivable turnover. Accounts receivable turnover just means how many times or how many days does it take a company on average to collect their receivables. So net sales divided by average accounts receivable is going to give you your accounts receivable turnover. Notice down here in this figure, Dell in 2013 had an 8.7 times or 8.7 days to collect on their receivables, right? But Hewlett Packard had a turnover rate of how much? How many times? What does it say there? It's in red. What's the accounts receivable turnover? What does it say there? 7. So it takes them an average of 7 days. Where is it? It takes Dell how many days? 8.7 or almost 9 days.